Good morning. Just half an hour away from the opening bell, Hong Kong, Shanghai, and Shenzhen. Of course, you're watching the China Show. I'm David Ingles with Rebecca Choong Wilkins.
Our top stories this morning. Nvidia's results drawing a muted response from investors, with shares slipping after hours. Markets are also digesting new Trump tariff details, even as the president stokes confusion.
And we're looking closely again at Chinese markets today. The rally in Hong Kong taking the benchmark halfway back to its all-time high.
Also ahead, Beijing said to plan capital injections of at least $55 billion to three of its largest banks as part of a broad stimulus package.
And China toughens its tone on Taiwan, calling the nation to shape their inevitable reunification. Let's try that again. Trump, meanwhile, refusing to say if the U.S. will protect the island from an invasion. Right, good morning. The headline, when you look at a lot of the market stories today, suggests that maybe we did start off from a point of weakness and softness across these markets. But as you can see, as some of these markets come online, and we'll get to the Hong Kong story in a moment here, do expect maybe more upside and upside momentum to push through. Taiwan, a quarter 1%. We're modestly higher now on the Asia Pacific. This, of course, is a different story on the, I think, the sluggishness of Nvidia, despite, of course, what, on paper, and we'll sort of unpack the story for you in a moment, really still a really decent set of earnings, plus a solid outlook on the stock itself. Brent, of course, seeing a little bit of a bounce, of course. Then again, this week we did hit a 2025 lows, more really on the supply story. And within the Japanese story as well, the Nissan one is out as well, 3%. New CEO could be in charge. We'll talk about that and the implications, and can they actually then revisit this potential marriage that fell apart even before they walked into the altar. Okay, very, very quickly, despite the sort of soft session sideways in Europe, slightly better in the U.S., this is what happened as far as the Chinese equity complex in the U.S. is concerned. 4% on Alibaba, JD.com. So these are the stocks we'll be tracking going into the open today, but certainly not an exhaustive list of the sectors to watch, which Rebecca will talk about later, everything from tech, everything to oil, chips, and everything in between. We did see a bounce in Chinese bond futures yesterday on the back of some injections coming out of the PBOC, maybe alleviating some of the concerns on the short end there. But as you can see, the futures in the early goings of Thursday are seeing some weakness. But, of course, just keep in mind, just a massive rally going into the afternoon session yesterday. So maybe we're just taking some of the steam off right now, off the top. Rebecca.
Yeah, that's right. And when we think about the HSI, though, we're really wondering whether or not we're going to be able to hit this key psychological level of 24,000. It did look like in intraday trading we were just sort of 6 or 7 points off that. We ended a little ways further down. And to Dave's point, a lot of sectors in focus today. We're thinking about e-commerce, EVs, chips, energy, banks. But I'll just pull out a couple of key stories. Obviously, Nvidia, one of, if not the world's most closely watched earnings came in. We had this upbeat view as well. And another Bloomberg scoop separately here, banks planning to recapitalize three of its biggest banks, China, injecting at least 400 billion yuan of fresh capital. Anyway, we'll go back to that big Nvidia story. We are joined now by Bloomberg Intelligence senior analyst Kunjan Sabani. Kunjan, let's just kick off. What are the numbers that really mattered when we look at earnings?
I think overall it was a middle-of-the-road earnings result versus implied expectations. Yes, they did beat and raise, but that has become something everyone expects of them. Though the magnitude of beat and raise have continued to come down, and it was the same thing we saw this time, especially on the outlook, which seemed to baked in some conservatism. There were some positives, the Blackwell numbers of 11 billion and the commentary around strong Blackwell ramp, which should ease the concerns around air pockets, but there were no new major catalysts that should sort of reboot an excitement here.
What about the guidance?
Yeah, like I said, the magnitude of the guidance beat was modest at best. That sort of implies that one, the 1Q, there is still going to be supply constraints on Blackwell, so don't expect anything massive upside there. And there's also that, I think, the looming risk of additional U.S. restrictions is sort of baking into that conservatism.
What was driving this sort of ambivalence in the investor response? I mean, we did have a bit of noise in shares, a bit higher, a bit lower. There was a bit of a reaction, it looked like, to this uncertainty over the tariff impact. But what is driving investor response?
Yeah, like at this point, the earnings was sort of a net equal for sentiment. There was some positive, like I said, easing those concerns, but then there was no major positive catalyst to stir up a sentiment change either on the positive or the negative side. And one thing to remember is we have GTC coming up in a few weeks. So we believe investors are actually waiting to hear and see what Jensen says at GTC before making any major moves to their analysis for this company.
Fantastic. Kunjan, thank you so much for taking the time. Kunjan Sabani there out of Bloomberg Intelligence, our senior industry analyst, of course, on these latest Nvidia earnings. More on the story coming up in a couple of minutes or so here. So Edwin Chan out of Mirae joins us to talk us through, well, what they think about Nvidia and, of course, a broader conversation around Chinese tech, which is also, I guess, arguably the other compelling story within the industry here as well. Rebecca.
Yes, and a busy day. I sort of got ahead of myself already during your market check, Dave. But yes, HSI in focus. Again, do we see any addition? We closed 3.27% higher yesterday. A lot of different sectors in focus. We've talked about Nvidia. The other plan is this plan to recapitalize 3 of China's biggest banks. And the interesting part here, we haven't really seen this actually since the 1990s when there was a bit of this credit crunch around bad loans. It's a very different scenario today. But the point underscores and speaks to the role that banks are expected to play. They're expected to be lending and helping the property crisis. They're expected to have loan write-downs for restructuring. So, yeah, think about how banks are expected and the role that they're going to play when we think about Xi's phase of economic reform. Elsewhere, earnings, we have HKEX, Sun Hung Kai coming as well, and this Evergrande hearing. Now, this is a little bit in the weeds, but the important point here is that we have Evergrande liquidators thinking about forming a COI. This is essentially a committee that would allow it to circumvent and sort of streamline the liquidation process. It means that those 2 liquidators can actually just go straight to this committee instead of going to the judge or to the court or to the creditors for every single decision. But there's a Bloomberg scoop here which speaks to the interesting tension in the story, and that is this Oaktree is coming in, potentially going to challenge. It's going to have its own liquidators. And I think the point really is, does this sort of open the gate to seeing not just an Oaktree or the 2 liquidators that we already have appointed by the court, but maybe 3, 4, 5 different liquidators starting to compete when it comes to those Evergrande assets. There's so much competition because it's so hard to get hold of those onshore assets. We're talking about hundreds, if not thousands, of units that need to be evaluated here. Finally, we have this UN-led meeting, climate meeting in Hangzhou. US scientists reportedly not taking part because of a stop work order off the back of the Trump administration. So that happens through to tomorrow. We'll keep an eye on that, Dave.
Yep. A lot on deck today, including the rally, as Rebecca was pointing out. So just to I guess, to channel our inner Bon Jovi here, we're halfway there now on the Hang Seng Index. From if you take the peak in 2018 back all the way down to 2022. And the other question, I guess, to channel Bon Jovi as well, do we lay the baby down on a bed of roses this time around? Always. We'll see. Let's bring in Sang-Mi Cha, our Asia stocks reporter, to talk us through this rally. And I mean, blistering run still. Yesterday, the afternoon session was astounding. So where are we right now in this rally?
Yeah, so our team was just talking about the southbound money coming in. The last 4 days, we've seen 60 billion Hong Kong dollars worth of stocks they bought. That's like 7.7 billion US dollars. That's a lot of money. And investors in mainland are actually not afraid of any sell-off time to time. They're actually really excited to buy the dip. And this is not limited to just southbound investors, but a lot of the global funds are coming back into Chinese stocks as well, adding exposure, given that they have really low exposure to Chinese stocks and heavy exposure in U.S. equities. So we are seeing a lot of that money kind of rotation back into China. And as yesterday, I remember Hang Seng Tech closed 4.5% higher. That was led by Alibaba, Tencent, Meituan, some of these tech giants that we talked about. So today we'll be looking at how they do it. And so after the Nvidia earnings, that's going to be the key focus. Of course, we're seeing some of the moves in Japan, Korea. So SMIC, Hua Hong, some of these chips are in focus, of course. But again, it goes back to the DeepSeek rally, and everybody keeps on talking about DeepSeek headlines, integrations with BYD or Alibaba Health. All of these are just like boosting these stocks in China.
So you mentioned some of those sort of big, heavy-hitting Chinese names, but how are some of the smaller, innovative tech names faring in all of this? And are we expecting any impact from the NPC government meetings to affect their outlook?
Yeah, so take a look at Beijing Stock Exchange 50 index. It's risen 30% this year. This gauge actually tracks these innovative technology companies like smaller and SMEs basically. And the NASDAQ of onshore Chinese stocks would be Star 50. That's also returned 13% this year. So we see this outperformance because there's just heavy presence in these tech stocks in these gauges. And what analysts are basically saying is that NPC, when they meet next week, and there is more support on the technology sector, this could actually prolong that rally and boost that sentiment. So that could actually mean that these stocks maybe can do even better, and the divergence between the other stocks can even drive higher and deeper. So we're going to be watching that point, although some of the market watchers are tempering their expectations because Beijing might want to actually leave some of that dry powder in case there is an escalation with the U.S. tensions.
Okay, fantastic. Sang-Mi Cha there, our Asia stocks reporter. We're looking at, speaking of the rally, it looks like, well, futures might be on the softer side of things. Some of these big names in focus are going to catch or catching a strong bid in the early going. So I'm looking at BABA right now, indicated, I would even say sharply high. I'm now looking at prices of 141. 142 here, which is a level we haven't really seen in, let's call it, about 3 years' time. Coming down to the open of trade, here in Hong Kong, in Shanghai, and in Shenzhen, you're watching the China Show. Good morning. We're just taking the temperature across the semiconductor space, and yeah, nothing on TSMC so far, and some of the other big names that have just started trading over in Taiwan, and of course about an hour back before that was in South Korea. Nvidia, bottom of your screens. Yeah, the lack of conviction post-earnings. Let's bring in Edward Chan, portfolio manager and senior investment analyst at Mirae Asset Global Investment. You guys own Nvidia, right?
Yes.
How have you managed that exposure recently?
Yeah, so overall for my portfolio, I'm just a touch overweight on Nvidia.
Okay.
But I think last night's result was pretty solid across the board. You could go into the little details and say maybe the January quarter revenue was a touch below the buy-side expectation, and then the April guide, I think it's kind of falls on the higher end of the expectation. So I think overall it's still quite solid. And then the margin on the Blackwell, I think it takes time for them to ramp up Blackwell to gradually improve the margin on that. I think that's well expected if you follow the supply chain closely. So I think overall it's still a pretty solid set of results.
Okay. I mean, the China tech story, we have to talk about DeepSeek.
Yeah.
How were you positioned going into that rally? And now the easy money has been made, how are you thinking about potentially adding exposure?
Yeah, so I mean, we've been overweight China since last year, so that has done pretty well for us.
When last year, just to clarify that?
In the second half last year.
Yeah.
And I think that's done well for us. And then for the DeepSeek, I think the key implication is that before the launch of DeepSeek, right, the expectation was that China's AI was sort of well behind US AI. There's just nobody really looking at any of the performance of the China AI model or the benchmarks. And then now all of a sudden you're putting China into the conversation again, right? Because you have a model that's so good that even a lot of the U.S. Tech companies are adopting this open source model. So that changes, I think, the narrative completely, right? Because I think the key implication is that China software companies, internet companies, all these tech companies now have access to a very competitive model where they could start build out their tech stack and build out all kinds of applications. So I think that's really a big change for the whole China tech industry, and there's a lot of innovation and development to be done here, and we'll have to wait to see what companies come up with. But I'm excited for what's to come.
The rally feels very momentum-driven, flow-driven. Do valuations matter at this point, or is that a sort of secondary consideration when you determine how much exposure you want to these big names?
Yeah, so I think one positive thing is that the valuation is coming from such a low point, right? If you look at where China were in the past couple of years,
if you think about it.
Yeah, and the expectation were so rock bottom on these earnings that you're coming off such a low point where even after this strong rally that we've seen, we're still at a pretty comfortable level in terms of valuation. It's nothing too stretched. I think actually whether you look at both China and the U.S. side, right? And, even if you look at U.S. The largest tech companies, the valuations are not really that demanding, and of course in China as well. So I don't think valuation is really the concern now. It's more like how does these innovations and the development that we talked about, things you could do on top of these very strong frontier models, could that bring earnings revision where you could really see the earnings expectations move up? And I think that's really going to be key to how sustainable this rally would be.
Could they?
I think that's totally possible. Yeah,
Okay.
A lot of the innovations are just coming in, right? We're seeing companies doing a lot in their products, and so I think it's still very early days in that cycle.
Dave and I have sort of been debating this with various guests this week. I mean, this question of, do you see this as a tactical play still, or are we at the beginning of a structural shift in terms of Chinese equities, Chinese tech?
I think it's hard to tell. Like I said, I think the key is whether a lot of these could play out into the earnings, right? Whether the government's policy shift towards the tech companies combined with the innovation that you could have in AI, could that eventually translate into earnings? Because if you look at the extraordinary performance of the U.S. tech companies in the past 2-3 years, it's really mainly driven by earnings, right? The valuations have not really moved up that much in the past 2 years. It's mainly driven by earnings. So I think earnings has to come for the China tech companies for that to be a more sustainable structural trend.
What are you seeing as far as fund inflows into your strategies or among your peers? Because I think that would be also, I guess, indicative really of who is buying into this rally and whether or not it's the fast or the patient money coming in.
Yeah, so I think we're certainly for overall the China strategy or China tech strategy, we're seeing more allocation, more inflow into that so far year to date. So I think certainly investors are looking to be turn more positive on China.
Okay. Yeah. And how do you think about how the U.S. is stacking up against China, against Taiwan?
Yeah, so there's a lot of complex geopolitics here and a lot of competition, right, in terms of the policy. But I think for me, coming from a semiconductor background, looking at the industry, it has been a constant really for the semiconductor industry, right? So we're quite accustomed to a lot of these policy changes and a lot of the regulation changes. So I think the industry and the supply chain is more adept to these changes by now. And certainly investors are not overreacting too much to these changes, and you're not saying if something new comes up, it's the end of the day. So I think the companies and supply chains are becoming more and more resilient to these changes and the competition. And the competition is to some extent healthy because you're seeing open source model being leading the technology stack, and open source model really coming from that history. Open source, the community doesn't really care too much, right, about country and all these boundaries, but really just want to build better products. So I think from that perspective, I'm positive.
Yeah, I want to pick up on that because that's a really good point about the open source model. The alternative version of this world is that we see, increased diversification in terms of the idea of sort of sovereign AI. Now, to what extent, if we see these sort of internal closed model systems dominate, does that change your outlook? Does it change how we approach these three different, these three different markets?
Yeah, so certainly, if the closed source models or the win, right, if you look at the perspective of a tech diffusion, right, in terms of access to the best tech, certainly that's a barrier because in certain regions where you don't have access to those closed source model, you're not able to do a lot of development on top of that, right? But if you have very strong open source model like we have today, it's really democratizing AI to a lot of companies and a lot of different countries, the way they could get access to the best models.
I guess along that line, we're now trying to determine, so if we're getting let's call it a decoupling on the software developer side, right? how far along that supply chain do we need to think about in terms of investment strategies? So in other words, what I'm trying to get to is if it's Baba versus, say, OpenAI, do we need to think about, does the world need a second fab play, for example? Is it only TSMC? Is there room for another one to come through? Like, how far do I split this supply chain down from an investment perspective?
Yeah, so I think the supply chain decoupling or a lot of these sort of national security driven sort of supply chain allocation has been happening in the past 4 or 5 years, right? So it will continue to happen, but the world is very integrated supply chain, as you know, and I think it's very difficult to completely decouple your supply chain. If you look at semiconductor, I don't think any country could build a very advanced semiconductor on their own entirely in a completely closed supply chain. So I think the world will continue to be this way. There will be competition, and then there will be certain areas where there's more restrictive, and then there are certain areas where you might see duplicated capacity. But broadly, we're still sort of more connected than versus, let's say, 30, 40 years ago, because of how far we've come, and how big the tech supply chain is today.
Okay, Edward, thank you for sharing your insights today. Edward Chan, Portfolio Manager and Senior Investment Analyst at Mirae Asset Global Investments. And stay with us. There's plenty more ahead. We are 7 minutes away from the open. You're watching The China Show. This is Bloomberg. Good morning. You're watching The China Show, and just a quick look at some of the stocks that we are watching today, keeping an eye on some of these Chinese EV names here, Dave, after we saw this rally in US markets overnight in Asia hours. NIO taking the lead there, 6.6% higher pre-market.
Yeah, it's worth mentioning that it's some of these names. Should I mention it? Yeah, why not? BYD and XPeng are really some of the names here. When you look at from a technical perspective, do look slightly overbought. Technicals, RSI, for example, some of the highest, in fact, are in this EV space. And unsurprising, because you're getting almost on a day-to-day basis, a double-digit gain here and there. So that's what happens. Speaking of double-digit gains, going into the close yesterday, so the financials, like these two specifically, up 19 and 17%. Respectively, we're down in the pre-market on this denial coming through out of the shareholder, Central Heijin, saying that there's no plan to combine the two firms, contrary, of course, to a prior media report. More on this in a moment. And, of course, speaking of financials, we're looking at the banks on the back of this other report coming through here that China is looking to capitalize the banks in the coming months. In what form and how much, what that means broadly for macro, that's coming up next, including the open. This is The China Show.
Good morning, welcome back. You are watching The China Show. We are counting down to the open of markets, less than a minute away here, Dave. And, well, we were looking when we came in today about whether or not the Hang Seng would hit this 24,000 psychological level. It does look like we are indicated just a touch lower.
Yeah. We did get very close to that yesterday, didn't we? A couple of points from that. I think the last time we were at 24,000 was, well, a couple of years ago. 2021, 22? 2022? Yeah, there we go. So, I mean, at some point, so I think for maybe just to start off this segment on a lighter note, a couple of months back, I put this, my annual sort of tongue-in-cheek bet with the markets out. When the Hang Seng was at 19,000, that if it got to 30,000, to be specific, if it closed above 30,000 by year end, I would get in a Princess Leia costume. And then our 24,000. So I did the math. We have to rally a further 24% from here. So I think Princess Leia stays in the closet for now. Yeah. We'll see. We'll see.
Star Wars fans might be relieved about that.
Although, if we do get to 31,000, that's the last thing you probably have to worry about, me in a Princess Leia costume, right? 4,000 level, We're close to that on the CSI 300. Nothing much to tell you about as far as well, I guess on the macro front, there was a PBOC injection yesterday of some liquidity. We did get a bounce on CGB futures. And going into this as well, the conversations broadened out to the banks, of course, given the reporting that Min will talk about in a moment here, that the banks are about to enter another round of capital infusion, similar to, I guess, what we saw during the Jinrong Weiji. There we go. That's the Mandarin for the day. The financial crisis back in 2008. Very quickly, Hong Kong is just a touch under 24,000. We're getting close to that now. 23.9 on that. HS Tech was up 4% yesterday. More on financials in a moment because there's a CICC denial. A denial from Central Haijin on the CICC Galaxy Securities merger. Flip the boards, please. List of companies coming up with earnings today. Won't spend too much time on this. And of course, we're looking at the big four banks on the back of that other report, which we'll talk about, in fact, right now as you look at the open for the big four with Min.
Yeah, I mean, let's think about this capital injection story. So Bloomberg Intelligence thinking that the move suggests more government rescues for the economy, easing the load potentially on lenders. Let's bring in our China correspondent, Min Lo in Hong Kong to break that down. I mean, let's start with the capitalization story. Why is this so significant? And I suppose, what is the difference between the moment we're in now versus some of the previous times we've seen this similar move? We think about the 90s and so on.
Yeah, it's quite significant in that it is the first time we are doing this since the global financial crisis in 2008. So our sources are saying that the government, the authorities are looking at injecting at least 400 billion yuan in the first batch of this capital injection into the three banks. Postal Savings Bank of China, Bank of Communications, as well as Agricultural Bank of China. So the 3 out of the 6 banks that will get this first round of injection first, that could be completed as soon as June. The question is, because all of China's big state banks actually are very well capitalized above that minimum requirement of 8.5%. So why do they need this injection? And some analysts are saying that it's because these banks could be asked to take on more credit risks. And we know that they have been enlisted to do so time and again to support the economy, to give out cheap loans to some of the high-risk borrowers like the real estate developers, the cash-strapped local government financing vehicles, and that has pushed down their level of profit margins to record lows and the level of bad debt to really high levels as well. So they're sitting on very high levels of illiquid assets, a big part of the balance sheet that is not generating cash, and that is a sort of risk for the financial system, given that the state banks are supposed to act as sometimes a shock absorber when there are risks, and sometimes they are asked to provide liquidity backstop for other banks to bail out the smaller regional or rural banks that have been struggling in this economy.
Can I ask you about markets this time with NPC obviously next week? And I guess this is a reminder of the heavy lifting that still needs to be done on the economy. Is there a market implication for next week? Because we've been talking about this rally that's been very focused and concentrated in just a few big tech names. Is there a case that this broadens out?
Yes, so our in-house equity analysts have been crunching the numbers based on 20 years of historical data. What they found is that Chinese equities tend to be pretty muted just before NPC, and they tend to decline maybe 1-2% during the week of NPC, but they tend to increase about a month after, as much as 5 or even 9% for certain sectors. And it takes some time for that positive momentum to come through, because people are waiting for the targets to be announced and then for local governments to enact these directives. And the best performing sectors tend to be the real estate sector, the materials and industrials. So some of the sectors of the old economy could benefit because they have been lagging behind the recent rally as well. And you look at real estate, we expect the policymakers to adopt the same stance as we have heard from the Central Economic Work Conference. So pretty supportive there. But the actual specifics of it may only be released, say, in the April Politburo meeting. We're also looking out for R&D spending, because that has been falling behind pre-pandemic levels. So still some room to increase fiscal R&D. And the key point here, I guess, is that rally could broaden. If we could show that chart that our producer Ernest made, you can see that the red chip stocks, which are the state-affiliated firms that are listed in Hong Kong, they have been lagging behind the HSI since September, and we could see that gap sort of closing after the NPC and that rally broadening out.
Okay, hat tip to Ernest, getting a shout out again today, of course, our charts producer here on Bloomberg Television. Min Lo, thank you so much, our China correspondent there. Let's talk about the economy and also markets. Joining us here on set is Xiaojia, Chief China Economist at Credit Agricole. Why don't we start with markets? Because I think 2 days back you put a report out entitled Taking the Glass Half Full Approach. What could sustain this market rally, which has gone up quite substantially already?
Yeah, so if we look at the upcoming events, definitely the most looking forward to would be the MPC for the markets, because we have seen a lot of discussions about the size of fiscal easing for quite some time, and this will be the venue that we learn those policy details and how the Chinese government is really implementing in terms of how to boost consumption, how to revive the private sector confidence, as well as to stabilize property market and fight deflation pressures. So I think for MPC we'll have a lot of that, and also in the year beginning we are lack of the real economic data. So far the data is showing improvement on multiple fronts, but whether this could broaden out from the latest the AI-driven momentum and also some of the anecdotal evidence that we have seen from the pretty impressive Lunar New Year spending data, then we will get more clues from the release of the economic data that is going to be released from March onwards. So these two are quite significant. Of course, this has been a lot of uncertainties planning out since the U.S. Trump administration. There have been a lot of uncertainties and announcement around the tariff, as well as some of the non-tariff measures, and some of them are indeed very close to China for interest.
Looking forward to the MPC, you have this detailed report out. Some of the numbers are quite close to what we're generally expecting for the consensus. So 5% GDP, 2% inflation target, 4% of GDP for the fiscal deficit ratio. But I want to ask what surprises you think we might get from the MPC that might catch investors unaware, either to the upside or maybe to the downside?
I think the size of fiscal easing and the policy details of how China is spending in terms of its fiscal money, I think that's the most important part, and we can get the pockets of surprises around that. So for the fiscal easing side, I think we are definitely seeing more supportive fiscal policy finally coming through, because in 2024, actually, there was a de facto fiscal tightening in a broad base. If we look at the augmented fiscal deficit ratio to GDP. And this year we are expecting that there could be net incremental spending on the fiscal front around 3 trillion, and that will be about 2.3% GDP increase, a percentage point increase in terms of GDP measured by augmented fiscal deficit. So within that, I think apart from the headline general fiscal deficit of 4%, we are probably going to see in total of 2.4 trillion in terms of special CGB issuances that include 1.8 trillion in terms of the expansion of those programs that we have seen from last year. So last year was 1 trillion in terms of consumer goods trading program, equipment upgrades, as well as those investment to support the strategically important projects, and also to further build up of those capacity for security reasons. So this year 1.8 trillion, and on top of that, 600 billion to be supporting the bank recapitalization. So beyond that, I think for local government special bond issuances, we think there could also be a 600 billion increases to about 4.5 trillion. So all this together, I think Chinese local government will be able to expand its spending to support the social welfare, to increase the subsidies and raise the income for those low income households, to expand those investment, as well as to give local government more capabilities in terms of buybacks of those idled land by developers, as well as to continue to support the initiative of destocking of existing home housing. So I think this could be a quite comprehensive bundle. But of course, if we compare to this size of easing and to the pretty aggressive expectations back 3 or 4 months ago, I think the size becomes relatively, more realistic or less aggressive compared to before. And also, I think lately there has also been a lot of, expectation building up in terms of how the PBOC will plan out its monetary policy easing, because clearly we are seeing that liquidity in the interbank market has been relatively high, and there has been likely delay of the policy rate cut by the PBOC. So the areas about how this monetary policy easing and the wordings around that would also be quite interesting to watch.
I just want to pick up on one point that you mentioned that is important here, which is this potential to see an expansion of social welfare. What are you actually expecting to see? So you think we're going to actually see an expanded model?
I think there are definitely a lot of areas that China could work on in terms of how to support those migrant workers and how to support the rural household, how to support those, the labor market, because if we see the unemployment rate for the youth is still relatively high. So for those areas where China could to support and also to gradually build up the social safety net to make the household more confident in terms of how they are going to spend. That is very important. Lately, we are also seeing some of the improvement in terms of positive signals in terms of property market stabilization, at least in the tier 1 cities. So how this property market stabilization would continue, whether it will continue, would also have some quite significant influences in terms of households' capability and willingness to spend.
And that key being that sort of confident story.
Yeah, exactly.
Thank you so much for joining us this morning, Xiaojia, Chief China Economist at Credit Agricole. And coming up in the next hour, we'll be breaking down Hong Kong's recent budget announcements with Moody's Analytics and CBRE Hong Kong. This is Bloomberg. You're watching The China Show.
Welcome back. You're watching The China Show. Now to the Trump and tariff story. So the U.S. president has given a series of apparently contradictory answers about his tariff plans. During a cabinet meeting, he was actually asked if he planned to move forward on these levies against Canada and Mexico next month.
Mr. President, can you clarify the Canada-Mexico tariffs? You had put that 30-day pause, but you just referred to April.
25%.
25%. When does it go into effect?
April 2nd.
April 2nd for Canada, Mexico.
Correct. And for everything.
Now, the White House later clarified the deadline for those tariffs remains the 4th of March, which is effectively, of course, in a couple of days. Let's bring in Bill Ferries, our senior editor, who's with us right now to help us just understand, and if there's anything really to read between the lines here, or did the president misspeak? And Bill, so I guess what? The tariffs are coming. Or is there a possibility that even if they're coming, they might get pushed back? I don't know where my head is at, actually.
I think the answer is yes. I think, there's a lot of mixed messages coming out of the White House. As you mentioned, the deadline, the extended deadline for these 25% tariffs on Canada and Mexico is Monday. So that is the date that people have been focused on. President Trump then suggesting it might be April 2nd, but it's not clear if he was perhaps referring to the reciprocal tariffs that he promised to bring on to countries around the world. So I think hopefully we'll get a little more clarity from the White House on this, maybe an actual schedule. There have been a lot of different dates when you talk about Canada and Mexico versus reciprocal tariffs. The president also kind of opening up to the idea that maybe there will be 25% tariffs on the European Union coming in the coming weeks as well. That was not something that was on anyone's plate at the time. There were expectations of tariffs against Europe, but not at the 25% level. So I think that cabinet meeting and that briefing with the press really opened up a lot more questions than answers over the last several hours.
Bill, just shifting focus to Taiwan, we've also seen this language coming from Wang Huning, China's #4 official, kind of slightly different language that we typically see describing the situation with Taiwan. Just lay out the nuances of this shift here.
Well, on the U.S. side, what I can say on Taiwan is that we saw President Trump going back to a much more ambiguous position about the U.S. Commitment to Taiwan. He's, of course, raised a lot of questions about how far the U.S. would go to help Taiwan during the campaign and in the weeks leading up to his inauguration. But it's a big shift from what we saw in President Biden's era when he came out unequivocally saying that the U.S. would come to Taiwan's defense. That was seen as a real game changer in policy. President Trump, over the last 24 hours, seeming to dial that back quite a bit, but actually going back to kind of the more traditional U.S. policy, which is more of a strategic ambiguity.
Okay, Bloomberg senior editor Bill Ferry's there. And sticking to that theme, here are some of the major political stories that we are also following this morning. The White House is ordering federal agencies to ready plans by March 13 for large-scale staff reductions, laying the groundwork for President Trump's most significant cuts so far. The plan also requires agencies to submit proposals to move offices out of Washington to cheaper locations. The so-called Department of Government Efficiency will help execute the plans. The White House has also enacted a new system for media access, giving it control over who is able to cover President Trump in certain settings. The decision sparked objections from the editors of 3 main news wires: Bloomberg News, Associated Press, and Reuters. Bloomberg was the only one of the 3 selected on the first day of the new system. The White House hasn't said how the pool will be chosen in future. A South Korean appeals court will rule next month on whether the country's main opposition leader violated election laws. A lower court in November found Lee Jae-myung guilty of making false claims in 2021 while campaigning for the presidency. If the ruling is confirmed, Lee will lose his parliamentary seat and won't be eligible to run in the next presidential race. The European Banking Federation is warning that a proposed dramatic rollback of the European Union's ESG rules will make it harder for lenders to analyse credit risk. Banks have been waiting for years for clients to start providing data points under new ESG reporting rules. But the EU is now proposing that about 80% of applicable companies no longer need to comply. There's plenty more ahead. You're watching The China Show.
Right, welcome back. You're watching The China Show, and the rally continues, really, in most names, not all, as you can see quite clearly on your screen. So, though, on a benchmark basis, we have taken out this nice round number on the 6,000 level. On the Hang Seng Tech Index, as you can see, we're up 2%. We're just coming off highs a little bit the last few minutes or so. Again, volumes are continuing to be on the higher, heavier side of things. Positive flows still, net inflows into Hong Kong still seem to be a feature of this market, so you're getting a lot of buying still coming across the Stock Connect. Oil stocks in focus, well, on a broad So the read through here is that big drop in oil prices holding near still 2025 lows as far as global prices are concerned, which, by the way, if you think about it, it's a good thing for most people in the world. Shanghai crude bottom of your screen, 0.7%. Right, this rally in these big brokerages, specifically these two yesterday, and they've now come out and denied this report that they are getting together.
Yeah, exactly. So that we had seen this big ramp up on the idea that they were going to merge. It does look like that now potentially isn't going to happen, but, you know, let's watch this space.
Absolutely.
We've seen a lot of mergers in this area.
Yeah, Guotai Junan and Haitong, wasn't it? There we go, a couple of weeks back. Consumer stocks in focus, Haidi Lao. We're still trying to figure out why this one is actually on the upside, but on a percentage basis, this is your biggest mover currently, I believe, on the Hang Seng Index. And as you can see, Antisports, Budweiser, APAC, and Chow Tai Fook are also leading these gains. Not to mention, too, and not on your screens, are these EV plays actually doing quite decently as well. Massive move, by the way, massive move in the U.S. session. Overnight, Li Auto, XPeng was also very much in focus there. So you are seeing still an extension of that rally overnight. And as far as the benchmarks go, on your screens coming up very, very shortly, it's still a story of the concentration of gains here in Hong Kong, although you are getting some upside still, though. Oh, okay, I now stand corrected there. Flat right now on the CSI 300. Chinese 10 and 30 on your screens. We're down a little bit as far as yields go. And, of course, dollar China. We'll talk more about this. There's an interesting observation here coming out of Mark Cranfield when it comes to the fix today and what they did and how they did that as it pertained to, I guess, they're keeping the yuan stable for now.
Yes, and coming up, we have an excellent guest to talk about that and more of the macro landscape. Speaker from BlackRock will be joining us. Good morning and welcome back. You're watching The China Show. We have been trading on the cash market for about 30 minutes. Let's just take a quick peek of what we're seeing. We did sort of now just starting to come off some of those highs, higher 0.4%, but really we were looking whether or not we get to this 24,000. There's still a ways to go. It is actually not dissimilar from trading that we saw yesterday, actually.
In fact, you could just take this visual and extrapolate this and put it on top of yesterday's date, and this is exactly almost how that looked.
Yeah.
Almost going into the close, 24,000, a couple of points from that, and then we pulled back to about the same levels right now, actually. Just being, no, you take a massive step back, though, right? We are where we are, 62% higher from the 2022 low on the Hang Seng Index. Effectively now puts us halfway back to the top if you take that retracement from the top in 2018 to that low. So how far we've come and how far we need to go, I guess, is the other question there, is the other issue. Let's put it that way. It's really been concentrated in offshore markets, offshore Chinese stocks, including, by the way, I should also mention the U.S., which the Golden Dragon Index really breaking free of that recent range. And while U.S. markets, separate story, U.S. markets have been really struggling to hit new highs consistently, the Golden Dragon Index has just sort of spread its wings. And as you can see, we're really seeing, at best, a small caps play today, large cap CSI flat right now, which is a completely different story from what they talk about in Hong Kong with MSCI China. 6,000 the Hang Seng Tech Index, 9,000 almost on the H-shares index, and as we were pointing out, 24,000 on the Hang Seng Index. Chip stocks in focus. We'll talk more about the Nvidia story, Nvidia effects, the lack of it in U.S. futures, in ADRs themselves, in after-hours trade rather than Nvidia. But as you can see, we're seeing it play out quite nicely, across these Asian semiconductor plays. And the broad read across markets is a rather tepid one, flat on the benchmark, flat on U.S. futures, sideways on the U.S. dollar. Right, let's bring in Mark Cranfield in Singapore for us for context on the market action or lack of it we're seeing today. Mark, you just inside baseball, you sent me a chart earlier on the Chinese currency, the fixing, and we've put the Bloomberg dollar index on top of that. We'll show that briefly now. Why is this chart significant?
You can see that's the PBOC's tactics, really. Since Donald Trump, it was clear that he was going to become the president of the United States. You can see how the PBOC is holding back any potential strength in the yuan. So if you look at what happened, the dollar had a huge slide last year, August, September, around that time. That was driven by the yen. That was when the Bank of Japan had hiked interest rates and people were capitulating from their short yen trades. We saw that big swoon in the dollar generally. And the PBOC allowed the dollar yuan fixings to go down pretty much in line with how the dollar was falling. Now that it's a completely different story. Since it became clear that Donald Trump was going to become president, they've held the fixings pretty steady, even though the US dollar is clearly starting to weaken again. So what you're getting now is a sense where the macro trade on a big scale here is that people are beginning to question the validity of the US exceptionalism story. The easiest and the first place that people want to do that, to express it, is by selling the US dollar. So clearly you're starting to see cracks appearing in this whole story that the dollar is a strong currency. It's beginning to weaken. It's probably going to get more extreme, particularly if the yen continues to strengthen. That's the one that's leading the G10 pack. Here we are. The fixings are pretty much steady around the 7.17 level. It's hardly moving from there. So what that means is giving China an advantage. They can keep the yuan relatively undervalued against other major currencies. Garfield Reynolds is also writing about what it means in terms of the euro. The euro most likely is also going to appreciate against the yuan in relative terms as well. So here we are. The PBOC is holding it back. The US dollar is probably going to get weaker overall, but dollar yuan will stay relatively firm in relation to that because of what the PBOC is doing.
Mark, shifting gears, the world's most watched earnings, Nvidia, came through. And something I'm sort of struggling to get my hands around is really why we're seeing this level of investor ambivalence around the results. Just put us into the mind of investors.
I think it depends which part of the world you're sitting in here. If you're based in Asia and you're very focused on the recent story and you still think the AI narrative in relation to China is going to do well, then Nvidia actually was a perfect result for you. The worst thing that could have happened from a global point of view would be that Nvidia had a big miss. It caused a disruption in US equities. People wanted to go very bearish on the US markets because of Nvidia. We've seen that happen once or twice before. But that wasn't the case. What we got reasonable results for Nvidia. No big deal in terms of the overall picture for US markets. People, as you say, they're pretty much shrugging it off. They're good results, but they're not fantastic. But they're not disastrous. From China's point of view, that's fantastic, because if you believe in the AI DeepSeek-driven story for China, you don't have to worry that Nvidia is going to mess up your story, because it isn't. They're going to continue to do okay. You can just focus on what are the good parts driving the China story. So from that point of view, if you're bullish on Chinese tech, it was the best possible outcome you could get.
Mark, sorry, just to interject, just a final thought. Does this mean, and I saw this on an MLive post overnight, the ambivalence, the lack of enthusiasm in the price action on Nvidia, does this tell us anything about whether active management and active strategies are probably the way to go now, and not simply blindly buy the S&P, that's simply a buy on the Mag 7, Mark?
I think we've been in a period really for a couple of months where stock picking really is coming back into fashion. It really is a time for, if you're a good stock picker, if you know your sectors, if you know your companies, if you really want to do your homework, now is your time. It definitely is not, if you just want to, as you say, if you blindly go long of indices, you're probably asking for trouble. It is not that kind of market anymore. And the intraday volatility is getting higher. There's uncertainty about whether tariffs are on or off, when they're coming, what kind of tariffs. All of that really feeds into, you need to know your companies very well, you need to know the specific stories, and you need to know what is driving those sectors. That's a much more bottoms-up approach than what we've been used to. For the past few years, it's been a very top-down, okay, I like the overall picture, I can buy the S&P index. It's no longer the case. Stock picking is back. So that's the way to go.
OK, that is the way to go. Bloomberg's MLive strategist Mark Cranfield with us. And we are also watching oil prices very closely today amid concerns over growth and the stability of global supplies. For more context, Bloomberg senior energy reporter Stephen Stepczynski joins us from Tokyo. First, Stephen, what are the factors that are pulling down oil prices, and how do we expect this story to play out?
This is a Trump story. It's precisely what you were talking about just a few minutes ago. It's the tariffs. Are they coming? Are they not coming for Canada, Mexico, the European Union? Trump did indicate that they are coming for Mexico and Canada, and that's creating a bit of unease across the market, because if there are tariffs, that disrupts trade, that disrupts consumption of oil, that's going to reduce demand. It's going to lead to this larger turmoil where you're in a much more bearish market than we were expecting a few months back. So we've seen a pretty solid sell-off because of that. And it does seem that the bears are certainly in the driving seat, at least for Brent crude and WTI in the United States at the moment. When you look at the pricing action, we're up, and down a bit today, but there are a number of bullish factors that in other years would have sent prices higher. The risk of sanctions, also from Trump, on Iran could reduce barrels from that country into the market. That would normally be pulling prices higher, but you're seeing that this trade war is really overwhelming the narrative and the view of a lot of the traders at the moment, and that's sort of pushing things down further. At the same time, you also have China. Chinese demand and economic growth has certainly sort of underperformed what some people in the market were expecting. Their oil demand hasn't been living up to the hype that others were expecting as well. And that's sort of taking a lot of that bullish air out of the room, and again puts focus on how the trade war could potentially reduce demand for oil.
Stephen, speaking of the geopolitics of the oil markets, what do we know about this reversal of some of these concessions from the U.S. that the previous White House extended to Venezuela?
Yeah, so this is another story that should be a bullish factor for the market, and yet you're not really seeing prices rise. The Trump administration, or Trump, said that he's going to reverse concessions given in 2022. He's likely referring to the ones that were giving to Chevron to develop oil in Venezuela. That is going to most likely result in Chevron having to leave the country in about 6 months or so, in that field not being developed. This is, of course, part of Trump's wider push. He cited a number of reasons, one of which being that Venezuela is not taking the undocumented immigrants from the United States. But it also, I think, if you just take a step back, it illustrates everything that I've talked about over the last 3 or 4 minutes has been Trump-related. It's all Trump. This is all Trump right now in the oil market, and it's difficult to digest it because he says different things that would be bearish, would be bullish. Now, if you take another step back, this is also good for Trump because he wants lower oil prices. That means lower gasoline prices, and that's something that he loves. If he can say to the citizens of the United States that you're paying less at the pump and it's because of me, well, that's a good story for the White House at the moment.
Yeah, okay, well, we'll wait for that story to come, though. Stephen Stapczynski there, our senior energy reporter in Singapore for us. But yeah, to the point Stephen was making, certainly oil prices are lower now. The catalyst and why that's so remains, I guess, largely out. Jury's still out on that one. Right, just ahead, speaking of China here, and we talked about this story a little bit. We'll get more into the weeds of this in a moment here, with China unveiling stronger language toward Taiwan as it announces new military exercises near the island. The details just ahead. Right, welcome back. The Treasury curve on your screens. Nothing much as far as the change in the curve is concerned. So we're up almost just equitably, just about across the curve there, 1 to 2 basis points. What does this mean for fixed income moving forward? And the opportunities really amidst what seem to be a U.S. equity market that seems to be hitting its head on a ceiling multiple times. Chinese equities on the side, of course, multi-asset. Where does this leave fixed opportunities in that specific market? Let's bring in Navin Saigal, Asia-Pacific head of fundamental fixed income at BlackRock. He joins us out of Singapore. Navin, good morning. As always, thank you for taking the time to speak with us. I just want to call the attention to our viewers right now. This is interesting that you put here. I'm looking at your notes right now. That don't ignore fixed income. You get 6 to 7% there without taking an excessive amount of risk. If you could define what is excessive amount of risk right now.
Sure. I mean, we are looking at an enormous target-rich opportunity set here. In the past, in order to get this kind of 6 to 7% yield that we're able to achieve today, you used to have to really go out the yield curve. Now, what does that mean? You used to have to lend to borrowers for a longer time horizon. It's a lot riskier when you lend to someone for 30 years as opposed to if you're lending to them for 3 years. Now, in the past, you used to be compensated for lending for a longer time horizon with a higher yield. Today, especially in the US, but in many parts of the world, you are not compensated that much for lending for longer time horizons. In fact, you can lend for 3 to 5 years and collect that 6 to 7% yield. Now, another thing, you used to be able to collect a higher yield by lending to riskier borrowers. So we call this going down the capital stack into high yield, into triple C, distressed credits. And today, you don't have to do that. Anywhere on the yield curve, even in the high quality part, you're pretty much able to beat inflation. And remember, fixed income investing or investing in general is all about capital preservation relative to inflation. You're able to beat inflation with relatively safe bonds for a relatively short time horizon. That's why we think it's a huge target-rich opportunity set to build this stable income stream, 6 to 7% yield, without taking a lot of risk.
Your preference for the shorter dated and shorter time horizons there, Navin, that part of the curve is slightly underperforming. And I guess that makes sense if you're still cautious on inflation and rates. But do you see a moment when you might be moving into, I don't know, medium-term, longer dated credit?
Yeah, you raise a good point. I think it's actually okay to start extending from, say the 2-year part of the curve to the 3, 5, maybe even 7-year part, the belly of the curve. And there are even opportunities in the long end of the curve. But here's where I think flexibility and being dynamic, being active is very important. I'll give you an example. In the long end of the curve, there are bonds today, especially in high quality in US corporates, where the bonds are trading at 50 cents, 60 cents on the dollar. If you have a bond that's at 60 cents on the dollar, that's 20 points of downside to 40 cents in a bad scenario. Recovery rates in the US are usually about 40 cents on the dollar on average, or 40 cents of upside. So it's a 2-to-1 payout because these bonds generally are investment grade quality and mature at par. So we like bonds, specific bonds in the long end of the curve, which are positively convex. But outside of those specific instances, we're pretty happy holding our carry, our duration in the belly of the curve, in that 3 to 7 year part of the curve.
Okay. Navin, can we ask you about either opportunities in mainland China or greater China, just to, I guess, expand the investable universe there? One of the comments we've heard this week around the economy is, we're past peak pessimism, and I'm wondering whether that's a catalyst in your view, to borrow your phrase, to start going down the capital stack and realizing perhaps more of the opportunity down in quality, up in duration.
We're definitely seeing the signs of it, that's for sure. Going into 2024, so this is the end of 2023, January 2024, I don't think there was a single investor that I spoke to who was long Chinese equities. And that changed very dramatically. When everyone is on one side of a trade, it doesn't take a very big catalyst to push the market the other way. Going into 2025, this year, there were almost no investors that I spoke to that were short Chinese bonds. Everyone was long Chinese bonds. I think for Chinese bonds, you can't expect the same returns in 2025 that you had in 2024. 2024 was an epic year for Chinese government bonds. And in 2025, the starting level of yields is just so much lower that the convexity, again, I go back to this concept of convexity, has shifted. And actually, we think there are more opportunities to play the bond market from the short side. Again, it goes back to that point, when the whole market is on one side of a trade, the hurdle or the catalyst to take it the other way is very low. And as we've seen, there have been some policy pivots, both bullish for equities and bearish for bonds, just in line with the economic prospects improving slightly. We've seen DeepSeek announcement. We've seen greater kind of collaboration or an intent to cooperate more between the government and private enterprise. These are all very positive developments, and the market can be caught off sides when it's all on the same side.
Navin, I'm interested in what you're liking in high yield in Asia at the moment. Particularly, I'm also interested in whether or not that's changed at all, because in general, we have seen quite a similar set of plays for Asia high yield going last year, this year. I'm just wondering if you see any new opportunities opening up, if your positioning and your kind of convictions have shifted at all in the high yield space.
I mean, almost anywhere you look, including Asia high yield, there are opportunities to allocate to that global diversified 6 to 7% portfolio. Within Asian high yield, I'll say that we like to be aligned alongside structural long-term plays, especially if they are aligned with the direction a country is going in, governments are going in. I'll give one example. I went to India recently. I've been twice in the last 6 months, and both times I've been surprised at the degree of focus on the renewable resource field. India is one of the largest or the hottest countries, and so one of the largest consumers of solar and wind power. They want to be. They actually view solar and wind power in India the way the US views shale, as a tool or a way for them to drive energy independence away from foreign oil. So within Asian high yield, we like the Indian renewable space. It's a long-term structural trend where we think there's no lack of projects, and we think we are getting good yield to lend in these projects, and we're being well compensated for the risks. That's an area we like.
Okay, thank you so much, Navin, for joining us. That's Navin Saigal, Head of Fundamental Fixed Income Asia Pacific at BlackRock. Stay with us. You're watching The China Show. There's plenty more ahead.
Right, welcome back. Going into the Tokyo lunch break, of course, the big story today, again, the one that almost got away. We'll see. Nissan up 4.7%. Change at the top. Bloomberg has learned that Nissan is drawing up plans to replace its CEO following another dismal set of earnings. And of course, if you didn't get what I was alluding to there, the collapse of talks to combine and merge with Honda. Let's bring in our transport reporter, Nicholas Takahashi, in Tokyo for us to talk us through what do we know about this potential shakeup at the top, and when might it happen?
It's another busy start to the day. What we know is that certain board members on Nissan have started to weigh different candidates for replacement for CEO Uchida. A lot of the news in recent months has sort of telegraphed this moment, least of all Nissan's poor earnings results in November, and then the tie-up with Honda that, as we know, fell through formally in February. As the search continues or sort of kicks off, I mean, needless to say, it's not an envious position to be in. Whoever does get this role inherits a company in crisis, one of its worst crises in 25 years. Not only are net sales falling through the floor, its debt rating has been lowered by 3 agencies, and it's on a search for a partner as its operating profit continues to decline rapidly.
Nick, where does this all actually leave Nissan, and what are the next possible steps for them?
I guess in a lot of ways, Nissan is back to square one before this tie-up with Honda began to materialize. I mean, for a couple weeks there, we thought there was a real chance that Nissan and Honda, two of the most iconic car brands in the world, two of the most iconic brands in the world, might team up and take on the world, so to speak. Now that that has fallen apart, Nissan is in desperate need of a new lifeline, or a company willing to take on its financial baggage. And our reporting has showed that KKR, the US-based private equity fund, was weighing an investment. We also saw an interesting report from the Financial Times last Friday that a high-level investor group in Japan was trying to orchestrate an investment from Tesla, and in some ways in combination with Honhai, better known as Foxconn, to invest in Nissan based on interest in its power plants and factories, in North America and Asia. Most parties referenced in that report have declined or denied the contents of the story, but what we're seeing now is a lot of suitors, if not vultures, starting to circle above.
Okay, well, look up and down, I guess. Nicholas, thank you so much. Nicholas Takahashi there in Tokyo for us, our transport reporter. And again, a very busy morning and the latest chapter here in the Nissan saga. Now, speaking of corporate Japan, and the latest on another sort of ongoing corporate story is 7 and 9. As you can see, shares are down substantially today. This is really after what seems to be financial issues might be leading to a collapse in this potential proposed buyout here. Management buyout of the company. We're talking about 9 trillion, of course, was the price tag on that transaction. So based on news flow right now, not going to happen or can't happen because of some constraints there. Right. That is, of course, just the latest there. We'll see what happens with this. Right. Very quickly, going into the last few minutes of the first hour of the Catch Market session. So some of these energy plays in China, coal in particular, as you can see, down as Citi downgrades the outlook on several of these names. Plenty more ahead. This is Bloomberg.
Good morning. Welcome back to the China Show. It's 11:29 a.m. in Tokyo. Japanese markets about to go on their lunch break. We are higher generally when it comes to the Nikkei. So 0.2% there, 0.5 on the topics, and a little bit of weakness coming through on the dot. Is that so? I might need my glasses, Dave. On the 10 years, sorry. Excuse
you know what?
me. On the 10 years.
I'm going to step in closer to that. That's an extremely small font size. Is that font size 8, guys?
Thanks, Dave.
Or do we just need to see an ophthalmologist here on our set? Just to mention as well, in terms of expectations around the BOJ, a top finance official in Japan says there's no issue with what the market expects. So no pushback is the short version there. The story across the markets, quite boring, if I'm being completely honest. Nothing much happening as far as the benchmark goes, and that's going to come up on your screens. The S&P and some of these contracts have been just bobbing around just above zero for the most part. We've picked up a little bit more momentum right now. Of course, there's the Nvidia story, which everybody will over-obsess about, for good reason, by the way, these next 12 hours going into the U.S. Open today. Sector movers, nothing much to talk about there. Particularly, though, when you look at Hong Kong. So we're just coming off, of course, it's almost 24 hours from the release of the budget. We have some earnings coming through out of Sun Kai today. HKX also very much in focus. The folks at Bloomberg Intelligence have put out a short note that the stamp duty cut that's the operative word, may boost sales of smaller homes, but nothing blockbuster as far as the real estate portion of the budget was concerned. And I think market's telling us that. There's really not much reaction here, Rebecca.
Yeah, I mean, we'll dig a little bit deeper into this. So the Hong Kong government is saying that it's going to shrink its workforce and accelerate a plan for economic integration with China as the city seeks new growth drivers to combat geopolitical uncertainty and a property downturn. Here's just a quick look at some of the key measures from the annual budget that was announced yesterday. And of course, I think, as makes sense, it's this 10,000 civil service job cut that has caught a lot of people's eyes here. Of course, the civil service is a sort of relatively major employer here. But the whole story for the Hong Kong budget really has been, how do they cope with lower revenue income coming in? How do they adjust for the budget deficit? As you say, we saw the lowering of stamp duty for cheap homes. And what qualifies as a cheap home is
that's relative, of course.
Exactly. It's an interesting question. Yeah. And then sort of dipping into the big narrative that we've been talking about this year, 1 billion Hong Kong dollars for AI research, 10 billion Hong Kong dollars fund for emerging industries, very much in keeping really with what we've seen in terms of this optimism around AI and DeepSeek.
Yeah, looking to diversify the growth pillars of the Hong Kong economy. And I think crucial to what Rebecca was just pointing out, right? Do we get to a point where we need to talk about the diversification of the revenue streams here of the government, cyclical or structural? Key question there. Well, let's put that question to our panel of guests. Joining us now is Heron Lim. He's with Moody's Analytics, joining us out of Singapore today, and also joining us here on set in Hong Kong is Hannah Jeong, Head of Valuation and Advisory Services at CBRE Hong Kong. Folks, thank you so much for joining us. Heron, let me start with you. on just a broad macro sort of economist hat on for us, if you could. We seem to be running into financial challenges in Hong Kong as it pertains to being able to match expenses. Is this simply cyclical in your view?
So this would be the fourth straight deficit that is being pushed by the Hong Kong government, and the sixth in 7 years. So I hesitate to call this cyclical at this stage. I think this is definitely structural, and this is due to really a lot of concerns with regards to its traditional revenue sources, including things like land sales, including things like property taxes, and the property market has not done so hot in recent years, leading to these shortfalls in revenue. And what did definitely surprise was that we didn't see a lot to do with the revenue side of things and the taxation measures that were rolled out in terms of increasing revenue seems to be very mild, and the expenditure cuts, although eye-catching as well, doesn't seem to be extremely big either, and therefore we are still seeing a deficit in Hong Kong. So that's why it currently looks a lot more structural rather than a cyclical situation.
Heron, you've used this interesting phrase here, calibrated austerity for Hong Kong. And I want to ask, what does that mean? And how meaningful are some of these, quote-unquote, calibrated austerity measures? Are we entering a longer period of calibrated austerity for Hong Kong?
It definitely sounds that way in terms of calibration. They are starting with the expenditure cuts first, and they are looking though at the state of the economy. The state of the economy isn't doing that well either. I think there were expectations out of the reopening back in 2023 that there would be huge growth. It didn't materialize. 2024 as well, a lot of headwinds for Hong Kong, and hence what we are seeing is that the Hong Kong government realized that they cannot just withhold everything, and that could lead to the economy going sideways or even shrink again, and that's undesirable for the economy. So in that sense, they are doing calibrated cuts, and therefore I would definitely see this as a calibrated austerity at this stage. But again, what did surprise is that they didn't do that much on the revenue front at this time.
Okay. Hannah, I mean, no major fireworks when it came to property. Just tell us the sort of shift in tone that we've seen and how disappointing that might be to investors.
I think the government put a lot of effort on the short-term measures instead of long-term. So we can see tone down of North Metro policy. It was a lot focused last 3 years, but this time government budget speech were very focused on what's going on right now and how they will deliver, but there was no tangible how they will raise the fund, who will be involving the North Metro policy development, etc. And then the land sales, if we look at it, they mentioned 8 site sales of residential and none of commercial and industrial will come to the market. I think they understand what's going on in the oversupply issue, especially for commercial sector, and that's posing the supply issue coming up. But again, government land sales not only including direct sales, but also there's other pockets like West Kowloon Cultural District, Airport Authority side. So whether government is managing a holistic way to supply those land in the periodical way, more systematical way. So that's a little bit more questionable, yeah.
This might be slightly technical, but there are, to your point, there might be issues in being able to encourage land sales. And are there things the government can do to improve just the friction out there? What are these things that seem to be standing in the way here?
I think government putting a lot of land non-urban area, very new territory area, which developers are not very keen to get in right now because there are cheaper land available in the urban. And then secondly, when you look at the tender document, they put a lot of a technical requirement or obligation. Like you must build how much of a GIC, government-related facility space, or how you need to maintain the slope, or how you need to build a site. So these are a big burden to the developer, given the construction cost is getting really high and high interest rate as well. So government need to push or separate those from the private sector, and then make sure that's done by government, and then make the site clean, so it's easier for developer to bid for the land.
I want to ask Heron here. Of course, a big question is that property has played a very important role in terms of Hong Kong achieving its growth targets. So I really want to get and dive a little bit deeper into your view on the government's growth targets, how they line up with, your forecast and outlook.
So we definitely don't see a lot of property changes in this year's budget, and we do think that the property segment will, actually, in terms of housing prices, will definitely go a little bit sideways in 2025. There seems to be a lack of action from the U.S. Federal Reserve in terms of rate cuts currently due to the implications of potential tariffs in the U.S. So, and what that means for inflation in the U.S. as well. So, and with the currency peg, the interest rates are not falling in Hong Kong. And if that's the case, we are not going to see a lot of improvements in the property segment. In fact, we are looking at a marginal fall over the year. And in terms of that, then what it implies for our growth forecast is that with the tariffs hitting both China and Hong Kong, we do think that China will struggle to hit even at the 4.5% level. We are currently forecasting about 4.2% for Hong Kong in 2025. My apologies, I am forecasting China 4.2% growth in 2025. And for Hong Kong, that means a 1.8% growth. That's even lower than the official forecast for Hong Kong, which goes between 2% to 3%. And I think the weakness there and the lack of confidence in the territory right now in terms of consumption behavior as well as business investments, that would be very tricky for in terms of this budget. We have not seen that many measures in terms of recovering that level of confidence, at least at this stage.
Right. And Hannah, let me bring you in. So, there are two growth pillars for Hong Kong, right? One is, if you think about it externally, to Heron's point, it's, the interest rate that we import, the export story that we have. There's also the mainland element, of course, which is the consumption coming through the visa schemes that have attracted a lot of talent. How much of an offset, positive offset, have mainland investors into the housing market been for the market? And what's the outlook there?
If we look at the residential transactions right now, over 100 million, majority of buyers are from mainland. So we can't ignore that sector. And but the thing is, they like to buy newer buildings. So those luxury houses at the peak may not be the priority for the mainland buyers. They like to buy the built apartment, very newer, with the good views. So slightly different taste from the Hong Kong buyers. In terms of forecast, I think Hong Kong, we are looking at the almost bottom for the residential market. So hopefully 2025, we hit the bottom and then see the slow growth second half of 2025. Luxury market, we still have a number of distressed assets coming up at the traditional luxury area. Therefore, it will take a little bit more time to recover. We expect another 1 to 2 years to come up.
Okay, Heron, I just want to ask you one final question. When we think about some of the big headwinds for Hong Kong, of course, there has been this risk, right, that Hong Kong gets caught in the crosshairs between US and China tensions. Where do you see the biggest potential challenges? Where is Hong Kong potentially most vulnerable when it comes to sort of being buffeted by, the world's two biggest economies?
So definitely the most direct impact will be on trade. Hong Kong's entrepot economy is highly reliant on trade, and therefore we definitely see in terms of trade numbers, they were not fair as well. But I would think that the finance industry could be in a bit of a volatility as well. And that's part of that reason is because of trade financing that it offers. And we have not seen fantastic numbers on trade financing coming out of Hong Kong. And given that there is increased regulatory scrutiny on the financial sector in Hong Kong, I think that from the US, I think that is also a potential risk for Hong Kong. So I think in terms of what we see, definitely trade, but also finance potentially could be under the spotlight from the US. And that presents that risk of in terms of downsides for the Hong Kong economy in 2025.
Okay, thank you. Excellent deep dive into the outlook for Hong Kong this year. Heron Lim at Moody's Analytics and Hannah Jeong, Head of Valuation and Advisory Services at CBRE Hong Kong. And you can get an insider's guide to the money and people shaking up the finance hub in our Hong Kong edition newsletter. That's out every Thursday. You can sign up via Bloomberg.com/newsletters. There's plenty more ahead. You're watching The China Show. This is Bloomberg. Good morning. You're still watching The China Show. Now, one of China's top officials has unveiled stronger language toward Taiwan that could signal greater efforts to intimidate the self-ruled island. It's making headlines in Chinese state media as well as on social platforms with the hashtag Shape the Inevitable Reunification of the Motherland. It's not necessarily the catchiest phrase.
No.
But let's dig deeper into this with our China correspondent, Min Min Lo.
It's more catchy in Chinese.
Okay, give it to us in Chinese first, can you?
It's a very long phrase.
We'll see you later.
So it's still long. Okay, that's the point. Okay.
祖国统一的塑造祖国统一的大事.
Boom.
There you go.
There we go.
Yeah. Okay, so look, what does this mean for China's stance when it comes to Taiwan?
Yeah, I would say it's a very, very subtle shift because Wang Huning, who is in charge of Taiwan affairs in China, he gave this speech and he said that China should shape that inevitable trend of reunification with the motherland. And reunification with the motherland is not new, but shaping that outcome is the new phrase that analysts have been catching on because it does suggest that maybe China is taking a more proactive stance here to fulfill that dream. And how are they going to do that? For a long time, China has had this two-pronged approach. The soft approach is to fold more Taiwanese compatriots into the Chinese community, providing more opportunities for Taiwanese businessmen and for students, promoting more cross-cultural exchanges. That's a part of it. And the other part is the hard approach, which is about ramping up military threats. It's about suppressing and curbing these external interference, which is a veiled swipe at the U.S., which has been the major backer for Taiwan militarily and diplomatically. Wang Huning also talked about consolidating the international community's adherence to the One China principle. And what this means, I think, is about intensifying the effort to peel off the remaining friends of Taiwan, the remaining 12 diplomatic partners, getting them to shift their allegiance to mainland China. And you can see some comments on Weibo, some pretty patriotic comments there. I think someone was talking about how, we should liberate the Taiwanese compatriots, let them watch Ne Zha. So it's almost like a rallying cry calling on everyone in China to fulfill this 大事, a mega trend that shows up everywhere in China. So imagine you're calling on the ordinary citizens, the private businesses, the media to just, get on board with this vision of China.
And what's, the interesting, almost paradoxical juxtaposition of this is you have the U.S. president who we know has commented on many items, but on this topic has remained, again, to the point that the U.S. has been strategic ambiguity, right? He didn't cross this red line.
Yes, so Trump was asked about this at his first cabinet meeting, and he basically avoided giving a clear answer, and that's not new. It is actually in line, as you said, with decades-long U.S. policy of strategic ambiguity. The Taiwan Relations Act actually requires the U.S. to provide Taiwan with the resources to defend itself, but it doesn't say whether the U.S. has to intervene. So have a listen to what Trump actually said.
Also your policy that as long as you're president, China will never take Taiwan by force.
I never comment on that. I don't comment on anything because I don't want to ever put myself in that position. And if I said it, I certainly wouldn't be saying it to you. I'd be saying it to other people, maybe people around this table, and very specific people around this table. So I don't want to put myself in that position. But I can tell you what, I have a great relationship with President Xi. I've had a great relationship with him.
So what he said actually differs from his predecessor because President Biden has repeatedly said that the U.S. will come to Taiwan's defense explicitly, although some of his administration officials have had to walk back some of his statements in the past. So Trump is essentially going back to the long-standing U.S. policy here, leaving everything on the table, and I guess that's the point, right, to keep you guessing. There's been a lot of confusion because the State Department did remove that phrase that says U.S. does not support Taiwan independence from a fact sheet, and at the same time, Trump has said in his campaign that he wanted Taiwan to pay for defense, and his weakened support for Ukraine also calls into question how he would deal with Taiwan, but then he has all these China hawks on his cabinet that would very likely be very reluctant to abandon Taiwan at this stage.
Min. Thank you so much. Min Lo, our China correspondent. As we go into the last few minutes of the show here, we'll talk more about these markets coming up. But on a price basis, we have reversed all of the early gains here on most of these benchmarks in Hong Kong.
Good morning. You're watching The China Show. A look at some of our top corporate stories now. YouTube star Mr. Beast is said to be looking to raise a few $100 million to expand his business. Sources say the funding round could value his company at about $5 billion. They say the content creator has spoken with several financial firms and wealthy individuals about investing. Mr. Beast, whose real name is Jimmy Donaldson, is raising money to fund a holding company for several of his businesses. Petrobras has announced $1.6 billion in dividends, short of average analyst estimates at $2.8 billion. The Brazilian oil producer reported a surprise net loss for the fourth quarter of $2.9 billion, blaming what it calls exclusive events, including currency losses. The company joins other energy majors, including ExxonMobil and Chevron, in rewarding shareholders despite strained cash flow. Shares of AppLovin fell sharply in New York after 2024's best-performing tech stock was targeted by short sellers. It saw a record intraday rout of as much as 23% before paring some of those losses at the close. Two short sellers allege that AppLovin misrepresents the benefits of its AI advertising platform and instead force feeds app installations onto phones to drive up revenue. AppLovin's CEO denied the allegations.
Right, just for a look at some of these big movers across the market. Let's start things off with Xiaomi here. We're down about 5%. Keep in mind, this stock has really been one of the, if not the best performing stock, depending on, I guess, where you draw the line. Set to unveil, of course, some of its product line there. And I think this also goes into the broader EV story on perhaps more products perhaps on deck, and it goes into the Tesla story, by the way, with FSD, of course. That's a separate conversation, but have a look at certainly at some of these EV plays that are tacking on and extending that massive rally that we had in the overnight session in the United States. Let's have a look, please, at the Hang Seng Index, just as we wrap up just the first 19 minutes of trade, and it's been a topsy-turvy session so far. We are going into, obviously, we still have a full hour, and then a full afternoon, and then a full session left. But as things stand, the jury is still out whether or not we will see a seventh week of gains. And certainly with the price action the last few minutes or so, we're down about 1%. That could be under threat, that weekly winning streak. Heavy volumes are coming through as we sort of pare back these gains. I should also mention, though, that mainland buyers are still net buyers of this market. So we still see a positive reading on these stock connect flows from the mainland into exchanges here.
Yeah, really a big question as well, whether or not we start to see flows coming from elsewhere. It's been a big point of discussion. Yeah. Do we start seeing more foreign investors coming back into this market? Yeah, not to the extent, certainly, that we've seen coming out of the mainland. Well, let's see. There's still Friday left, so we'll see you all tomorrow on Friday. This is it from The China Show this Thursday.